Well, Telstra is definitely one of those businesses you don't even notice until things go wrong, and unfortunately this week we really noticed. It's an essential part of Australians' everyday lives, but how does it stack up as an investment? Let's dive in and have a look. So this week we took Telstra apart, we rearranged its accounts. We always do that first just to get a picture of what its underlying operating business looks like. And the first thing that struck us was the flatness of its sales from 21.6 billion to 23.1 billion over 5 years. The AI revolution seems to have passed them by. We had a look at its NOPAT, that's our preferred measure of profit. It's basically its operating profit after tax, what the actual operating engine throws off. And again, completely flat. Telstra does have some interesting moats though. There's two that we could see in the accounts. First of all, it's Telstra consumer business segment. You're thinking mobile phone plans, broadband, the ubiquitous retail stores. That's their biggest revenue and profit generator. And then apart from that retail facing stuff, they've also got an interesting segment that they call Telstra Infraco. And this is their construction of pipes, data centres, fibre, towers, that sort of thing, and renting them out to other telco players and the government. So then we had to think about the quality of those moats, and there are a couple of chinks in the armour. The first one being Elon Musk's Starlink business. That is a satellite internet business. It's only really a threat to Telstra in regional areas at the moment, but if that becomes a bit more usable in urban areas, there is a looming threat there maybe in the future. And the other issue is the government is a very, very powerful customer of Telstra's. They can jack up the fees that they charge Telstra for basically the airwaves, the mobile phone spectrum that Telstra uses. So they do have moats, but they're not the perfect ones. And we see this in the numbers. When we dig down into RONOA, that's the return on net operating assets, we got 8.5% for that, which is not exactly world beating. Okay for a mature telco, but not the sort of thing that's going to create you a lot of money over the long run. We looked at its return on equity, 13%, a little bit better, but again, not spectacular either. We also have to check when we're looking at return on equity, how much of that is being generated by financial leverage, debt, borrowing, and you can see there that financial leverage has increased and is doing a little bit more of the work there. A lot of people say the dividend is very attractive for Telstra, worth a buy for its dividend, and yeah, it does look really useful. The management have protected that really well, steadily growing over the years. The other thing to say about the dividend is at the moment it's around about 4.3%. Now you compare that to Australia's 10-year government bond yield, which is up around 4.8, 4.9. You get that with no risk every year compared to Telstra, which does have some equity risks. I can't really see the argument for buying it as a dividend stock either. But every share has the right price, so we put it through our 4 valuation models just to see where fair value sits. And given everything, we think that fair value is somewhere around $2.34, which is way, way below where it is trading at the moment. And our buy zone would be somewhere with a margin of safety around about $1.76. So that's Telstra. It's got a lot of retail reach. It's got an interesting infrastructure business, but at the wrong price, I don't think it's a very compelling investment. All right, well, that's a wrap. If you've ever got a company you'd like me to look at or any questions, please just reach out. Good luck with your investing. I'll catch you next time.